It's another business day. Good morning, everyone. Welcome to 55 minutes of current and relevant business conversations. That's what we do here in Business Morning. I'm Amy John Mekwa, and we start as usual from the global space. What's happening with oil prices is steady on Tuesday as investors weighed a smaller than expected increase to OPEC Plus output in November against signs of potential supply glut. So looking at the numbers for this morning, we see a change from what we had yesterday. It's green now. Yesterday we had more of red. So we've seen an increase there, bringing it up to $66.09 after it gained almost 1% in just a couple of hours, because by yesterday afternoon it was still in the red. WTI is also up, but it's up more than 1%, at $62.39 a barrel, and both contracts settled more than 1% up in the previous session after the Organization of Petroleum Exporting Countries and Russia, as well as smaller producers together known as OPEC Plus, decided to increase collective oil production by 137,000 barrels per day. That will begin from November. Meanwhile, Abu Dhabi National Oil Company has set the November official selling price of its benchmark Morban crude at $70.22 a barrel. Been a while since we saw Brent or WTI hitting that $70. And here in Nigeria, the electricity distribution companies, that's DISCOs, generated 564.7 billion naira in revenue. That's in the second quarter of this year, and it reflects an improved billing and collection performance. This is according to the Nigerian Electricity Regulatory Commission, NERC. And then the regulator said that DISCOs billed customers 742.34 billion during the period, achieve a collection efficiency of 76.06, and that's up from 75.81 that was recorded in the first quarter. The report highlights ongoing efforts to enhance revenue recovery amid rising operational costs and metering challenges across the power sector. And talking about metering, still from that report from the NERC, shows that they installed 225,631 meters in the second quarter of 2025, and this represents 20.55% rise from the 187,161 meters that were installed in the first quarter. The figure disclosed in the report, that's the Nigerian Electricity Regulatory Commission's second quarter report, also says that of the total installations of 147,823 meters, that's about 65.52%, they were deployed under the meter asset provider, that's MAP, that framework provided. That 65,315 were done through the MAF, that's the Meter Acquisition Fund, and then 12,259 through the vendor financed model, and then finally 234 was achieved through the DISCO financed scheme. And from April the 1st, 2026, POS agents in Nigeria will be restricted to working with only one principal. And the CBN said that the new framework aims to strengthen the enabling environment for offering safe financial services to the underbanked and remote areas in the country. It also replaces all previous agents' banking regulations, consolidating existing frameworks into a single document. Key changes to agent banking operations: agents will continue performing long-standing functions such as cash-in and cash-out transactions, naira fund transfers, and bill payment. They may also assist with account opening forms and submit them on behalf of their principals. However, super agents, those are entities licensed to recruit, aggregate, and manage agents, are now prohibited from offering agent banking services directly. Principals will also have the discretion to determine which services their agents can offer, guided by internal risk assessment frameworks and the CBN's operational standards. We'll certainly bring you conversations on that to help you understand and digest some of those changes that will be coming with the new guidelines when it has to do with POS agents and, operators in the country. Let's see how the market closed yesterday. Closed in the positive, not as positive as the previous session, but still positive, and bringing us close to 145,000 level for the oil share, and closed at 144,995.25. The equities cap has gone to 92 trillion naira yesterday. Again, I think again about 11 billion at the close of trade. Looking at the activity, we see a mixture right there, but more of red. The volume dropped as well as the deals, but the value still retained the green color from the previous trading session. Top gainers were mostly insurance. We have Cornerstone and Connell PLC. Those are insurance, and then Chams. Top losers had Living Trust, Austin Laz, and Julie Pharmacy. And then top trades had Analysing. We hope to bring them on the program really soon, making some big strides there, Analysing, and that's why we see them in the top trades. I believe we can have that conversation tomorrow. Hopefully we'll be able to do that. Access Co and Chams also made it to the top trades yesterday. Let's take a short break. When we come back, it's a story or a topic that's all around now, and a lot of negative sentiment around it, but let's see, perhaps find a balance, and that's the capital gains tax. It's part of the tax reform. Implementation starts in January, a couple of months from here, and it might just affect you when you're in the stock market or any other market, but we'll dissect that after the break. Please stay with us. You're welcome back. Nigeria has increased the capital gains tax, CGT, on foreign investors trading in its equities market from 10% to 30%. A policy shift expected to reshape participation dynamics in one of Africa's top-performing stock and has been touted as the highest on the continent. That's the new tax rate, which is effective January 2026. It's part of the federal government's revised tax law under this administration led by President Bola Tinubu, which aims to strengthen fiscal discipline, boost non-oil revenue, and reduce budget deficits. However, the other side of the story is a threat to participation in the market. So we see there some of the information that you might want to know on this new tax rate that's effective January. Double taxation risks, that's one of the fears. The expansion of Nigeria's CGT to cover indirect transfers raises serious double taxation concerns. Investors, particularly cross-border holding structures, these are some of the concerns that have been shared. And every person who has disposed of a chargeable asset must file a self-assessment return and pay the tax computed not later than June 30th and December 31st of the year of assessment. So let's delve into this now, and we're doing this with partner Tax Regulatory and People Services at KPMG. Joining us virtually from here in Lagos is Mr. Akinwale Alao. Mr. Alao, good morning and welcome to the program.
Good morning. Thanks for having me.
Good to have you. So just when we were looking to attract more Nigerians, especially to the stock market, the fixed income market, we hear of this capital gains tax. Could you tell us about it and how you think it would be implemented?
Okay, so I think it's important to just say that capital gains tax has been in Nigeria for a while. It was introduced firstly for the first time in Nigeria in 1967. So it's been around for about 60 years. But there have been some major changes that have happened over the last few years. Some changes were introduced by the Finance Act 2021 that basically introduced taxation of gains derived from the disposal of shares. Previously, those gains were not treated as chargeable gains. And since then, there's been tax on the disposal of, or on gains derived from the disposal of shares. Like you mentioned earlier, the Nigeria Tax Act is looking to revamp the tax regime in Nigeria. And based on the provisions of the Nigeria Tax Act, there won't really be a capital gains tax the way it currently exists. What would happen is that capital gains that are derived by companies or individuals will now form part of their income for the purpose of income taxation. And so for corporate investors, for instance, that derive capital gains from the disposal of shares, those gains will form part of the profits that will be reported for corporate income tax purposes. So that's how it would shape up starting from 1st January 2026.
So is it every time you take profit, for instance, if you're dealing with stocks, is it every time you take profits you're paying this tax? We know it's moved from 10% to 30%. Yes, I believe so. Please correct me if I'm wrong.
So the capital gains, the taxation of capital gains will not be done as a transaction tax. So it's not every time you take profit that you'll pay tax. What is expected is that companies that make gains during the course of the year will report those profits as those gains as part of their profits for the purpose of taxation. And of course, there will be relief. So if there are losses, for instance, that can be taken as a deduction from those gains, those losses would be deducted. The net profits is what companies will then pay tax on. They will pay corporate income tax on it at 30%. All other things being equal, and then there would also be development levy at the rate of 4%. So that's how it is expected to play. And there are reliefs or exemptions. So, for instance, where a company has derived gains from the disposal of shares and it reinvests the proceeds of the disposal in another Nigerian company, then those gains will not be liable to tax. So basically, the taxation of the gains can be deferred through the reinvestment of the gains in shares in the purchase of shares of other companies that are Nigerian companies. So there are ways of managing the tax point when it comes to gains derived from shares.
Okay, so I think one of the exemptions I saw is if you're dealing with government securities. Is that included?
Yeah, so those won't be liable to tax, basically. So gains derived from the disposal of government securities won't be liable to tax.
Okay, but it's a long list when you look at generally what capital gains tax is about. So it covers asset, properties, and all of that. But you seem to be explaining it from the perspective of companies. Are you saying that individual investors are not affected?
So individual investors will also be affected, but the gains that they derive would form part of their income, and it will be liable to personal income tax. So under the new regime of the Nigeria Tax Act, there is a tax band that ranges from 0% all the way to 25%. So the maximum rate is 25%. And so individuals that have derived capital gains would report those capital gains as part of their chargeable income. And depending on the income band that they fall into, they would be liable to tax. But the highest rate would be at the rate of 25%. And it's also important to note that for individuals, the exemption threshold should really cover most of the individual investors. So any proceed, so disposals of shares that don't exceed 150 million naira in a year, and where the gains derived from those disposals are not more than 10 million naira, those gains will not qualify as chargeable gains, and so they will not be liable to tax. And I think the majority of individual investors may fall into that category. And so you may find that, except they be very wealthy people, many individuals that play in the stock market may not be liable to tax on the capital gains that they derive from the disposal of shares.
Okay, so any transaction that's less than 150 million will not be taxed. But what if, we're Nigerians, what if an individual has a transaction of more than 150 but decide to break it? Maybe take it like 2-3 times instead of making it a lump sum that will hit 150 million. How does the system detect that?
So the 150 million naira threshold is the aggregate threshold for the year. So it's not the threshold per transaction. And so at the end of the day, if you have an individual that has maybe disposed of shares, maybe 50 million the first time, 50 million the second time, 100 million naira the third time, in aggregate, that individual would have crossed the threshold of 150 million naira. And so that individual would need to figure out, the gains that have been derived from the disposal of those shares and will pay tax on the gains. The tax will be payable under the income tax regime by that individual. But if you have an individual whose aggregate disposal during the course of a year of assessment is not more than 150 million, then that individual will not be liable to tax if the profits, the gains derived from the disposal of those shares does not exceed 10 million naira.
So that's really taxing the rich. So you said the tax will not be at the point of transaction. So help us to understand the flow. You said it's going to be on income and gains. At what point can an individual expect this to take effect, assuming it's an individual transacting gains of above 150 million?
So an individual who is transacting above 150 million naira in terms of the proceeds and has derived capital gains would be expected to report that income as part the capital gain as part of the income for that year of assessment, and would file a return on the income that's been derived. Will file a return by the 30th or 31st of March of the following year, because that's the deadline for filing returns by individuals.
All right, and I saw some suggestions, some reports calculating that the government will make about ₦1 trillion annually from this. Where does the money go to? Does it go to the FIRS? We're still using the FIRS now. How is it redistributed? Can we trace it? So it's not just about generating revenue for the government, but can we trace it and feel the impact on the economy?
Well, so I don't know if the amount to be generated will be, is $1 trillion. Unfortunately, I don't have my crystal ball here, but what I would say is that it may be difficult to track what the tax that will be derived from the disposal of shares would be, because, like I mentioned, the gains that are derived will form part of the income tax returns of individuals and of companies. And so unless maybe one does a deep analysis and one has information one has access to information that's available to the tax authorities, it may be difficult to know what component of the incomes that have been reported or profits that have been reported by individuals or companies that relate to the gains they've derived from the disposal of shares. So it's going to be difficult. But to answer the question you've asked about where the money will go to, for companies, the gains that are derived will form part of the profits that they report for corporate income tax purposes, and the company's income tax that they pay will go into the federation account when it's collected, by the tax authority, by the Nigeria Revenue Service, as it would be known, starting from 1st January 2026. For individuals, the gains will be taxed as part of their personal income, and so the income tax would go to the tax authority of their state of residence. So if I'm based in Lagos State, for instance, and I've derived capital gains, I would report that as part of my chargeable income for personal income tax purposes. And when I file my return and pay my tax, that will be paid to the Lagos State Internal Revenue Service.
So that obviously is more revenue for the government. And already with the removal of subsidy, there are questions as to the impact of that. I know that, this time we're talking about the law, the tax, and it's about the collection. But really, we've seen dissenting or heard dissenting voices in other parts of the continent when it comes to tax increases and all of that, because the people can barely connect increased revenue to government to welfare and economic development and all of that. And since this question, it becomes even louder with the new tax law, which takes effect in January.
Yeah, I agree. I think there's a concept of tax morality, which is typically looked at from the point of view of the taxpayer. The taxpayer ensuring that the income that they earn is subject to tax and they don't engage in aggressive tax planning. But I think tax morality also needs to be looked at from the point of view of the government, of the tax authorities, because if taxes have been collected, the expectation is that they will be judiciously used to improve the lives and livelihoods of the citizenry. And so, the expectation is that maybe government will be held to greater account. Individuals and corporate citizens would expect the government to do more since there would be increased revenue flows into the treasury.
Well, some people say it will be time, or it will be a motivation for more Nigerians to get interested in what the government is doing, because if more people are paying taxes and your money is going somewhere, then you'll be forced, whether you like it or not, to follow the money and find out what's going on, and that might lead to more accountability. I wonder if you have that perspective too.
Yeah, I absolutely agree with you. It would result in more citizen engagement, and it would also, I expect it to also translate into more interest in even the electioneering process, because that's where it all starts, ensuring that the right people are elected into office, people that have the credibility, people that have the capacity to then use the revenue that will be generated by the government for the benefit of the citizens.
But there's also the fear, on the other hand, of dumping, that some investors might actually run away because of this, especially when it's being touted as the highest, in Africa, talking about the 30%?
Well, I think dumping may be a bit of an hyperbole. I believe that maybe there will be there are ways to manage this. Part of the concerns that have been expressed is the impact that the introduction of the Nigeria Tax Act would have on maybe gains that have accrued over time. So maybe someone bought shares of a particular Nigerian company 5 years ago. The share price has increased significantly, and if there's a disposal in 2026 and capital gains arise, if the gains are not reinvested, or if the proceeds are not reinvested, then that individual could be exposed, or the company could be exposed to tax on the entire gains that have been realized, as though the gain was realized only in 1 year. So that's part of the fears that have been expressed. But since there is exemption for proceeds that are reinvested, where the gains are up to a certain threshold, and I believe that there may be a way to manage that. Also, I believe that investors will take advice on how to manage this, because there are actions that can be taken, for instance, before the end of the calendar year, to also mitigate the impact that those kinds of positions may have on the investors.
All right, thank you so much for sharing all that knowledge with us. Partner, Tax, Regulatory and People Services at KPMG, Mr. Akinwale Alao.
You're most welcome. Thanks for having me.